Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. Well, there was a lot of excitement in the markets on Thursday after the Fed cut rates by a somewhat larger than expected 50 basis points during Wednesday's FOMC meeting. As Yogi Berra famously said, you can observe a lot just by watching. And in truth, we ourselves had signaled some time ago of the solid probability of this happening by the simple expedient of just looking at the last two times the Fed had acted at interest rate peaks. Now, as far as the FANGs are concerned, it seems to me that the question on the floor is, does a rate cut, or even several, again assuming that history is a good guide to the coming months, does a rate cut mean much to the FANG stocks? And in particular, do rate cuts meaning much or anything at all for the AI stocks in particular, which have dominated the performance of these stocks of late? I expect that the answer is not really. The last two non-COVID related rate cutting exercises were a prelude to a recession. And if this one is as well, the very expensive AI stocks already facing a decline in the trajectory of their demand outlook are not likely to fare well. If anything, yesterday's rate cut is a warning, not a promise. For the moment, I'm content to watch the FANGs and see if there's any follow-through to yesterday's market action, although already the answer appears to be more caution than optimism. With that as a background, without further ado, let's take a close look at the FANGs for this week. As always, before I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, well, let's start off with NVIDIA. And we've already had a 2 breakpoint decline in the stock from its peak valuation. It's been sort of 2 down, 1 up, although a little bounce here. Interesting to see that there is not much of a change, just a little tiny little bounce in following that rate cut. And not surprising, look at what's happening to the trend of the fair market value. It's starting to ease off a little bit. And if we take a longer look and we put NVIDIA in some kind of long-term context, let's look at the last time the fair market value eased off. The stock declined from its HB6, at least down to its HB12. That was I think a 62% decline, something in that kind of an order. So it doesn't take much in a slowdown in the outlook for this company for there to be a large decrease in the price. So I think we need to be very, very cognizant of that, particularly with the flattening of the fair market value and now that little down tick. I am very, very cautious here. Amazon, if anybody is going to benefit from a rate cut, maybe it's Amazon for consumer confidence and consumer sales. Anyway, it's broken out sort of, not decisively, but sort of over its bubble price. And as long as it's there, well, I guess we have to be there. But we are there with our heart in our hands if the bubble price fails. So, yes, we'll be there, but very, very cautiously. Alphabet, of course, this is right now, this is my favorite stock. I had a perfect hit at its mid-super growth price. That's 5.5 times book value, and is now bouncing nicely. I like the action here. Microsoft, I was expecting that we would get a decline to its HB1, and by the way, I think I still do. The trajectory of earnings in the fair market value remains very, very modest, and I think the stock is probably heading down at least to its HB1 and perhaps even lower. However, we'll cross that bridge when we get there. Meta just continues to dither either side of its bubble price. Right now, it's on the north side, and I guess as long as it's on the north side, we cross fingers and hope for higher values. Talking about the fair market value, we see that is actually ticked up a little bit, so maybe that is a promising development. So I think we hang on here with some trepidation, but I think we hang on here for the time being. Apple, well, what can we say about Apple that we haven't said already? The sales and the earnings trend of this company are just very, very indifferent. And in the meantime, the valuation of the company is, the fair market value is a long way below the current price. I continue to be very, very cautious towards Apple. Tesla, if I guess if there's a winner in a rate cut, it's got to be the auto stocks and the electric vehicle companies. The only problem, of course, is that when we look at the trend of the fair market value, of course, we haven't got the rate cut maybe factored in yet. I don't know whether analysts will change that or not. But the stock is some 76% overvalued, and the trend is at best flat and at worst weak. Finally, Netflix has been nestling up against its HB2 now for some period of time. By the way, it was nestling up right back here. Okay, and then of course the new balance sheet here, which you can see by the little diamond, kind of pulled the structural prices down, but that was actually the peak of the stock. This stock could break out. It has been much higher by at least a couple of breakpoints, which is a big rate of gain, but it's got to break out first, and I will believe it when I see it. So to recap off the top, I see that NVIDIA barely budged from its downtrending setback from its HB7. That's 43 times book. And that should not surprise us, as the fading outlook for artificial intelligence applications and hence chip sales going forward does not bode well for the price of the company. Jensen Huang is trying to beat the drum and maintain the enthusiasm for the shares, and is he ever? But grossly expensive is grossly expensive. The decline in the fair market value measure, which we can now plainly see, is potentially lethal for the share price. Extreme caution is my watchword. I could possibly put in a good word for Amazon in light of the rate cut, if the consumer is able to maintain and increase their confidence in the outlook for the economy. But the bubble price has to hold. Yes, I would own these shares right now as SVA directs me, but I would have one finger on my sell trigger if. I said last week that Alphabet is the kind of opportunity that I avidly look for. A perfect direct hit at its mid-super growth price, 5.5 times book, and is rallying. When I see stocks acting like this, I remind you that I generally recommend to my clients that if you would like to play this stock, this is the best time to buy. If the stock then subsequently fails to hold here, you have the least downside risk of loss. Why? Well, consider that if you do buy and you're wrong, that is to say, if the stock pulls back and then fails to hold at its breakpoint, you will find out quickly, and you can sell equally quickly before a tiny loss becomes a big one. Microsoft has given us no useful signals in the past 2 weeks, and as far as I'm concerned, its downtrend from its HP2 price is intact. And of course, if artificial intelligence and NVIDIA are fading, then I would want to be very cautious towards the chief proponent of the whole movement. Meta just continues to dither around its bubble price. For investors, I would refer to this stock as maddening meta. It's cheap as the FANGs go, but the shares refuse to connect one way or the other at or slightly above its bubble price. Apple continues to drift very slowly lower. No surprise given how expensive the shares are and how very, very slowly the sales and profit are growing. Tesla acts well, sort of, despite horrific fundamentals, in my analytical opinion. Now, with the rate cut, one can make a good case for improving auto and electric vehicle sales. And if you ignore the very modest return on equity and downtrending fair market value measure, perhaps you can also make a case for holding the stock. I am inclined to be bull-headed and maintain a sell on the shares anyway. Finally, Netflix could be trying to break out over its HP2, that's 12 times book, and head back up to its all-time high, a couple of breakpoints higher. But as I said, the proof of the pudding will be that phantom breakout. Anyway, that's all for this week. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.